boys, so this is the 2018 ratios question. And it follows much the same pattern of the 2019 one, except it's looking at it from a different context. So the first thing I'd always say to you is have a read and see where it's from. Read what you're asked to do in a report and keep that in your mind as you're going. So it says, indicate whether the debenture holders will be satisfied with the performance, state of affairs and prospects. You're looking at debenture holders, which means less emphasis on dividends, less emphasis on emphasis on profitability, but a big emphasis really on your middle section, your liquidity and gearing, and always taking into account whether the debenture holders will be confident that the money will be paid back and the interest will be paid. So any time in previous questions where we spoke about increasing the likelihood of dividends being paid, we need to think about that in the context of the likelihood of interest being paid and the loan being paid back. Okay, so a couple of things I would always work out before I get going on the ratios. The preference shares, a preference dividend, 8% of 200,000 is 16,000. Write that down somewhere and have a look and see what's happening with the interest. It's happening afterwards. So we'll just go on with the questions there. So the first one you're asked to do is the cash purchases if the period of credit received from creditors is 2.5 months. That's very, very similar to the last one. So we need the period of credit formula. So the period of credit formula is creditors by 12 over credit purchases, and we know the answer is 2.5. So we look and we go find our creditors, they're 80,000. We don't know our credit purchases, that's what we're going to find out. So 80,000 by 12 over credit purchases is 2.5 months. So we can just bring out those sums a bit further. So that would mean 960,000, 80,000 by 12 is 960. Over credit purchases is 2.5. So if cross multiply, you'll get 960,000 is 2.5 times credit purchases, which would mean credit purchases are 384. Now, we would normally then from there say, well, credit purchases plus cash purchases is total purchases. But there's nowhere in the question here that tells us what total purchases is. But we have enough information. Okay, we've got the idea that cost of sales is 560, opening stock is 60, and closing stock is 90. So 60 plus purchases minus 90 is 560. So if we just do the opposite backwards, well then 560 plus 90 minus 60 will be purchases. Okay, so that's how we go about doing that. So total purchases, cost of sales minus opening stock plus closing stock, so minus 60 plus 90. So our purchases is 590. Of course, if you want to check that, 60 plus 590 is 650, minus 90 is 560, and that would be correct. So now we've got our purchases is 590. We know our credit purchases is 384. So our cash purchases has to be the difference between the two of those, which is 206,000. Okay, and that's our first 10 marks. Okay, so that should have been all right. Second one, dividend yield. They're pretty much, they don't really change the ratios too often, so you'll get asked dividend yield quite a lot. So dividend yield, it's a 2:1, in that it's dividends per share over the market value of one share. Dividends per share we have to work out. Okay, so dividends per share is ordinary dividend over issued ordinary shares. So why it's a good idea to work out the preference shares, you're going to use that now. So dividends paid is 19,000, dividends paid is 45,000. Preference dividend is 16,000. So 45 minus 16, and we put that over the number of ordinary shares, which is 350,000. So we get a dividends per share of 8.29 cent. And then dividend yield is dividend per share over market value. You've got your market value here of 135. It's always the one at the bottom. So 8.29 over 135%. Remember, if one is in cent, put them both into cents. And dividend yield is a percentage, so remember to multiply it by 100, so that's 6.14. Next one's the price earnings. So we know the price earnings is the price over the earnings per share. So we have to work out the earnings per share. All right. So earnings per share is net profit minus preference dividend over issued ordinary shares. So 82,000. Take away our preference again, we'd work that out. So take away the 16, and we put that over our issued ordinary shares of 350. That gives 18.86. So price earnings will be market value 135 over 18.86, which is 7.16 years. So it's going to take us just over 7 years to get our money back based on current earnings. Next one after that is return on capital employed, net profit plus interest over capital employed. So 82 plus 18, capital employed, last number in the balance sheet. So 82 plus 18 over 930 is 10.75%. That seems to get asked all the time as well. Then our final one is interest cover. So this is a really important ratio for debenture holders. So it's how many times we can pay our interest back out of our profits. So it's net profit plus interest over interest. So 82 plus 18 over 18. And that gives you an answer of 5.56 times. That's part A done. Very, very quick through that. It'll take you a bit of time yourselves to do, but it shouldn't take you too long once you know the ratios. Okay, so we're on to our report. Now, even though it's debenture holders, we're going to follow the same process for performance, state of affairs, and prospects. And that performance takes into account profitability and dividends. State of affairs, liquidity, gearing, and interest cover, and then we also put in another one into that security on the fixed assets. And then prospects, that just sort of leaves you with the sector. So again, be aware it's debenture holders, and you're asked to give an opinion. So give an opinion. Now I know that a couple of these ratios aren't great, and the trends are downwards. So I'm going to say that they won't be satisfied. Now, you could leave that to last, but you remember just to put it in somewhere. Okay, so if you leave it to last, you'd say, therefore, the debenture holders, based on all this information, the debenture holders would not be satisfied with the performance, state of affairs, and prospects. So if we look at the profitability, following my set of notes, you're going to have full marks or very close to full marks, as long as you take the context of the debenture holder. So profitability, first of all, sorry, Shannon, it's not called Shannon, they're called, what are they called? Born to Run. It's a profitable company with a net profit of 82,000. And nothing new in that. We worked out the return on capital employed to be 10.75. If you compare that to last year, it's decreased from 12.4%, so that's a negative trend. However, we can say it's well above the risk-free rate of return of around 1 to 2%. Okay, so we can say that. Now, it's also above the cost of borrowing. That indicates they're making efficient use of resources. Now, that's all great, but it's still, they're less profitable this year than before, so we need to make reference to that. So at the end of it, you need to say, well, they are making efficient use of their resources, however, they're making less efficient use of their resources, and this drop in profitability will concern debenture holders. Now, I looked at the marketing scheme, and they've put in the price earnings ratio, or the earnings per share into that. I can't remember which one. Let me just check here, the marketing scheme. They put in earnings per share. I don't really know why, but anyway, they did, probably trying to scaffold that a little bit. You don't have to write about return on equity funds for debenture holders. Okay, so we move on to the to the dividend policy. So The dividend policy, again, for shareholders, they have to put a real emphasis in dividend policy. For debenture holders, the focus is really on interest cover. Now, I put the whole lot in, even though in the marking scheme, they only really write about interest cover. And there isn't a lot of marks going for it. It's only 4 marks versus 7 and 8 for the rest of them. So I still followed it because I didn't know that, and you never know what they're going to throw in, and given the amount of time you're going to have, it's a good idea to get everything in. So dividends per share is 8.29, down from 10%. That's a negative trend. The only thing is, it's a negative trend for shareholders. It's not necessarily a bad thing for debenture holders. I didn't really write anything about it being trend-wise. If everything was very obviously positive or negative, you could put in that it's a positive or negative trend. Dividend yield, 6.14. Now, we worked that out, I think. And that's a decrease from 6.25, which is given to us there. Now, I put in that debenture holders may be satisfied to see less of a return to shareholders because it increases the opportunity to pay interest possibly in there. Now, I still want to put in that div yield is the real rate of return to shareholders, and as well above there is for rate of return of 1 to 2%. Again, there's no marks going for it. Where the marks are is here. The dividend cover is 2.28 times. Last year's dividend cover was 1.3 times. So this is positive as Born to Run is retaining more of its profits. For the repayment of loans and future expansion. That is in the notes, that sentence. So it's really important we get that in. That the dividend cover is falling, which is a good thing for debenture holders because they're keeping more of their profits back for the repayment of the loan or future expansion. So when we did the interest, when we did the last question, it was from the context of shareholders, and we said, yeah, falling dividend cover isn't bad because they're keeping some of the money back for future expansion. In the context of debenture holders, you should also put in the repayment of loans in there. Okay, so again, that'll get us the full marks there. And state of affairs then next. Now, this is the most important section, and this has to if the news is bad in liquidity, we're going to take an overall poor return on this. So for liquidity, again, I'm not doing the current ratio because they never asked the current ratio. Okay, so for liquidity, we worked out the asset test ratio, current assets minus closing stock to current liabilities. So 160 minus 90 is 70. 70 over 80 is 0.88. That's a decrease from 1.3 is to 1 in 2016, which is a negative. And I put in a concerning trend. I wanted to put in that it's bad, and again, we're worried about it because it's, as it is below the ideal of 1 is to 1. Sorry, that should say. Born to Run has a liquidity problem, so we're explaining what it means, as they only have 88 cents of liquid assets for every euro of short-term debt. Okay, so we'll explain what that means. And then where does the concern come in? Well, the concern comes in their ability to pay interest and pay back the loan. So keep referring back to the interest on the loan from here on in. So debenture holders will be unhappy as the company is putting itself in a position where it might struggle to pay its interest on the loan and to put money aside to repay the future, or the loan in the future. So if it was all positive, they'd be happy because they can put money aside to pay interest on the loan and pay the loan in the future. But in this case, it's bad. So we want to take that negative view. We're going to refer to that liquidity a few more times before the end of the answer. So the gearing and interest cover. Now, Born to Run has gearing of 53, and that's up from 41, which we know is a negative trend with gearing. We have to say what that means. So it's gone from being lowly geared to being highly geared, which means they're now more financed from debt than equity, and we just have to get that sentence in. We have to basically explain each of these ratios. The interest cover is 5.5 times, which is down from 6.3 times, which is a negative trend. And again, we're explaining what interest cover means. It's the number of times that interest can be paid out of profits. Now, 5.5 times is high, so it's a strong position to pay their interest at the moment. But we want to refer back to the fact that they've got poor liquidity. So they might have the money, but they don't have the cash. So while the company is in a strong position to pay its interest, this falling trend along with poor liquidity would concern debenture holders. So it's quite high, but tied in with the fact that there's falling liquidity, That's where the concern comes in. Now, security and real value of fixed assets, we only put this in for debenture holders. We don't put it in for shareholders. So, again, there's notes in this. I might update them a little bit. Some of them say just comment on things without actually explaining what you say. But we say what the fixed assets are. So the fixed assets are 650,000, and compare that to debentures. They're well above the 300,000 debentures, which they'd be happy with. And then we should always put in what the tangible assets less the debentures is. So you've got a net position of 650 minus 300. So they've fixed assets less debentures of 350,000, which they'd be happy with. Now, you always put in this line. However, the real value of fixed assets cannot be given as no depreciation policy is given in the balance sheet. That's going to get you most of the marks. Now, comment on the investments because they're given. So they've got investments that cost 200,000, but they only have a value of 150. Now we want to take a negative tune of that, so debenture holders won't be happy with the performance of these investments. It says something about the management, basically. Okay, and that gets us on to our final section, which is prospects. So for future prospects, we can only really write about the sector. Now, we have to come up with a negative view of the sector. So how to think about it. They're in the sportswear industry, or a retailer in the sportswear industry, so they're lifestyle sports. I was thinking, well, what would be bad about being a retailer in the sports sector? I thought, well, the first thing that's bad is that no retail is open. So in the short term, we can put this in. So in the short term, there's a concern because these businesses haven't been open for 2 years due to coronavirus. That's obviously not true. It's not 2 years, but 18 months for a lot of them. And of course, some of them were open. It's a highly competitive industry with leading brands dominating, such as lifestyle. And there's also strong online competition. So think about where you lads do a lot of your shopping. A lot of it is probably done online. So that's the short term. Remember, we always said we also write about the long term. Now, I want to give some sort of hope. So in the long term, well, the prospects might be strong because there's an emphasis on keeping fit. Now, I don't know where I got that. I thought they were, is it swimwear? So I misread it and saw swimwear instead of sportswear. All right, unless it says it somewhere else. No, it doesn't. Anyway, I put in there's a renewed interest in sea swimming that they could take advantage of. You'll get marks for all this. They may require large spend in advertising, and given their current liquidity problems, this might not be possible. I wanted to keep referring back to those liquidity problems. Okay, so that's it done. Again, at the end, you might go back for all of these reasons. Debenture holders would be concerned. Okay. Part C then, you're given 3 sets of ratios. What advice would you give? Now those 3 ratios are all liquidity ratios, believe it or not, and we just never refer to them. They give an indication of liquidity, and the only time we ever really use them, and I'd say this is true a lot of people in a lot of schools, the only time we ever use them is in the ratios at the start. So what do they mean, right? That's basically what the question is. What do they mean and what do their trends mean? So period of credit allowed to debtors is the amount of credit we give to our debtors. So the amount of time we give before debtors pay us back. So we want that to be low. So it's gone from 60 days to 40 days. So that's a positive trend. Period of credit received from creditors, we want that to be high. So that's the amount of credit we get. So it's gone from 20 to 34. So we're getting more credit. So that's good. Good for our liquidity. Stock turnover is the amount of times we sell our stock in a year. The higher that is, the better, and this is falling. So what can we say? So for the period of credit allowed, so we say what it means. So it's the amount of time it takes a debtor to settle his account has improved from 20 days, or by 20 days from 60 to 40, and that's a positive trend. You're getting your money back quicker. And it's like collecting cash quickly improves liquidity. I'm going to continue to focus on liquidity because it goes back to born to run. Still greater this is still greater than the period of credit received, which is not ideal. So we're getting 34 days and we're giving 40 days. That is not ideal for liquidity, even though the position is improving. Okay, for the period of credit received, well, it's getting better. We're getting way more. Still want to take somewhat of a negative view, but anyway. The length of time has increased from 20 to 34, so 14 days. And what does that mean? It means you have a greater chance to sell your products, and that could improve liquidity. However, not paying off debts reduces the chance of getting cash discounts. If that was lower, you will probably get cash discounts. And then thirdly is my stock turnover. So it's worsened. So we were selling our stock 12 times a year. Now we're selling our stock 6 times a year. So what does that mean? It means we have a lot of cash tied up in stock. So it's taking longer to sell stock. So cash is tied up in stock. When cash is tied up in stock, that's a liquidity issue. Okay. So the overall effect is, the advice I would give them is, do not buy the business, because you are already a business with liquidity issues, and this company might add to your liquidity problems. Anyway, I hope that's of use to you, lads. I will continue on doing these, probably one a day or so over the next week, and we'll see you when we get back.